We're going to talk today about the most awesome home loan program available across the country in rural areas and small towns. It's the USDA Home Loan Program, which is an incredible home loan program that has zero down payment out of your pocket. So I'm going to talk today about this awesome home loan program so you can understand more about it and how it works. And we're also going to talk about how you can potentially qualify for a USDA loan. So first of all, a couple key points. As I already mentioned, this is the most incredible aspect of this loan is that it's a zero down payment program. Nothing out of your pocket for the down payment. Now you are going to have closing costs as with any loan type, so that's something to keep in mind. But there also are ways to minimize the closing costs out of your pocket as well, and we're going to talk about that. The other thing is about a USDA loan is that the mortgage insurance is lower than other loan types. Now, with a USDA loan, mortgage insurance is referred to as a guarantee fee, but it's the same thing with USDA as mortgage insurance. So there's two types of mortgage insurance with a USDA loan. There's an upfront guarantee fee, and there's a monthly amount that's added to your monthly payment. These are both lower than an FHA loan. If you've been looking at loan options for any amount of time, you've probably come across the FHA loan. It's another really common type of loan if you have very little down. And that upfront portion is lower on a USDA loan compared to an FHA loan. The other thing is that the monthly amount is also lower on a USDA loan compared to an FHA loan. One more thing that I wanted to mention is USDA also in most cases has a lower monthly mortgage insurance premium than a conventional loan, which is another really common type of loan. Conventional loans are traditional loans backed by Fannie Mae and Freddie Mac, so very common out there. So these are some of the key aspects of a USDA loan and what makes it so incredible and so affordable for so many people. So let's get into a little bit more about this program. So the first thing is, what is USDA? So USDA stands for United States Department of Agriculture. This is a government-backed mortgage for rural home buyers. And this is a really important distinction because it's a common misconception that a USDA loan can be used to buy a farm or some kind of a agricultural property that's in a rural area. And that's not really what it is. It's not at all what it is, actually. USDA is a program designed to help people buy homes in rural areas. So these are homes that people are going to live in. They are not where a business is being run or a farm is being operated. They just are homes that happen to be in rural areas. Now, rural areas aren't just in the countryside. These are also many small towns across the country. And I'm going to show you this, that there are a lot of areas that you'd be surprised qualify for a USDA loan. The next thing I want to talk about is what is a guaranteed USDA loan versus a direct USDA loan. If you've been researching USDA loans on the internet, you might have come across this because there's a lot of talk about which one to get. So a guaranteed home loan or guaranteed USDA loan is a USDA loan that you would do through a broker like myself. These are lenders that are approved by USDA to underwrite files according to USDA's guidelines, and then USDA backs that mortgage. They insure the mortgage. A direct USDA loan is a USDA loan that is done directly through USDA. Now, you could do that, but one word of caution is that if you go with a direct USDA loan, it's going to be a much longer process, much more tedious. USDA is hard to deal with directly. So you're going to have a much more streamlined and faster process with better communication working through a broker like me. And then the next thing is, this is a common misconception, is that a USDA loan is only for first-time home buyers, and that's not the case. You do not have to be a first-time home buyer to qualify for a USDA loan. Let's talk about the down payment. This is the best thing about a USDA loan. It's one of the very few programs still available across the country with no down payment. But it's important to know that if you apply for a USDA loan, if you have your own funds in the amount of 20% down, then you cannot, plus closing costs, you cannot qualify for a USDA loan. So they look at this as a program that helps people that are in need of a low down payment or no down payment program. So they will ask you to document your assets. And if you have too many assets, enough to do a 20% down payment on a traditional conventional loan, then you can't qualify for a USDA loan. Closing costs. Let's talk about this part. I mentioned that a little bit earlier. So there's closing costs on any loan that you might obtain. And the same is true for USDA loans. There's a couple different categories of this. The first is the upfront guarantee fee. Now, like I was saying, compared to an FHA loan, which is a 1.75% fee, it's not bad. It's a 1% fee, meaning, let's say you take on a $200,000 USDA loan. That means that your guarantee fee is going to be $2,000. So you don't need to worry about it, though, because you don't have to come to closing with the guarantee fee. You can finance the guarantee fee into the new loan. So in that example, you'd be borrowing $202,000. There's also other closing costs. There's fees from the lender typically. There's the title company, which is the entity that handles the closing. You have to get the house appraised, so you have to pay the appraiser. Usually there's fees involved with recording the deed with the county. And then some states have transfer taxes that you need to be aware of. So these are just some of the fees and charges. And if you'd like to give me a call or reach out to me by email, team@clearpathhome.com, I can get you an estimate on what your closing costs might look like. On a USDA loan, another thing to know is that you cannot waive escrows. So escrows means that's where the lender collects 1/12 of your taxes and insurance each month, and then they pay those bills on your behalf when they're due every year. So you cannot waive that with a USDA loan. The USDA lender has got to collect your taxes and insurance and pay those escrows on your behalf. So this adds to your closing costs at closing. So it's something very important to keep in mind and something that your lender should be looking at and making you aware of. Now there is a concept called a tax proration that may help your closing costs. This is a credit that the seller gives you towards your taxes for the portion of the year that you didn't own the house. The reason why is that when you go to pay the taxes in 2024, the year I'm filming this video, the 2024 taxes pays the 2023 tax bill. So you're paying those taxes what's called in arrears. So since you didn't own the house for that portion of the year, you're actually paying that future tax bill. You're paying for taxes for part of the year that you didn't own the house. So the seller is going to credit you for those months of taxes based on when you close on the year, and that's going to lower the bottom line that you have to bring to closing. There's a couple other ways that we can finance closing costs. One is that you can ask the seller to contribute towards your closing costs up to 6% of the sales price of the home. So if you buy a $200,000 home, they can pay up to $12,000 of your closing costs and other fees. The other thing you can do on a USDA loan that's unique to any type of loan is that you can wrap the closing costs into the loan. The way this works is you can finance on a USDA loan up to the appraised value of the home. So if the appraisal comes in over the sales price, you can finance that difference in closing costs into the loan. So let's take the example of our $200,000 house. If that house appraises at $205,000, that means that you could finance $5,000 worth of closing costs into the USDA loan. That's the difference between the appraisal, 205, minus the sales price, 200, is 5,000. So if you want to take a look at these numbers, I wanted to put up this quick slide to give you my contact information. My email's there, my phone number. I can help you to get pre-qualified or to look at your numbers more in depth. It's no obligation and no cost to look at this, so definitely reach out and I can help answer all your questions that are coming to mind. But let's get into a little bit more particulars about how you can qualify. So the first thing is I alluded to seller credits. I want to talk a little bit about seller credits because you might be thinking, I don't have $5,000 or $6,000 in closing costs, and I don't know if the appraisal is going to come in above the sales price, so what do I do? So one thing you can do is you can ask the seller to pay your closing costs. Seller credits is what this is referred to, and seller credits can go up to 6% of the purchase price. So again, on a $200,000 house, that means the seller could pay $12,000 worth of closing costs. Now you might be thinking, why would a seller agree to this? This might reduce the appeal of your offer. Your offer might not seem as strong, and that's true. It's definitely true. So what you have to do sometimes depends on your market. Talk to your real estate agent, and we have tons of great real estate agents that we can help recommend to you to help you with this. But to make your offer more appealing, you may need to offer more on the house. So in that 200,000 example, if you want them to pay 12,000 in closing costs, you may need to offer 212,000, ask the seller to pay 12,000 in closing costs, and then the seller still gets the 200,000 that they were looking for the house. Let's take an example of a $400,000 home, and let's say the seller agreed to pay 1,000 of your, or 1% of your closing costs. So in that example, that's 4,000 in closing costs. Let's say your closing costs are 6,000. And remember, USDA loan, 0 down payment. That means to buy this particular house for 400,000, you're only coming out of your pocket with $2,000. That's a heck of a good deal to get your foot in the door and become a homeowner. So really, really powerful. Now the bank is going to ask for proof of funds. What this means is we're going to document where that $2,000 is coming from, or however much it is you need to bring to closing. So this is verified through 2 months of bank statements. We want to see that it's been in your account for 2 months at least. If you have any large deposits during that time, we're going to want to see where those deposits came from. So we're going to have to get statements for those accounts that came from. You could also, another thing that sometimes people do is they take a loan on their 401k. And this can be a really savvy way to get your foot in the door, because a lot of times on a 401k loan, the interest rate's pretty good. And if you pay yourself back, you don't lose out on that benefit of having that 401k. So you can eventually pay yourself back and realize your entire 401k. And because it's a loan that you're loaning to yourself, we as the lender don't look at it as a loan. We just look at it as you using your own funds. So that's really important. You can also get a gift from someone who doesn't have an interest in the property. So in other words, you can't get a gift from the real estate agent or the seller, except for if they do seller concessions, but you can't get a gift from anyone that has an interest in the property. You could get a gift though from a family member, as long as they're not living in the property with you. You could get a gift from another relative. So that's another way that you can help to finance your closing costs. Unsecured loans are not permitted. So if someone just decides to loan you $2,000 and it's not secured by any property, that cannot be used on a USDA loan. You also can't use cash on hand. So in other words, if you have a stack of $100 bills buried in your backyard, if it hasn't been in your bank account for at least 60 days, we cannot use it because we can't verify that that's actually your money. So we don't know where it came from. So no cash. And then, like I was saying, large deposits into your account not from earnings, not from your job, are prohibited. Now, prohibited is a little strong. You can have large deposits as long as we can document where the large deposits came from, and as long as we can document that it was your money or that it is your money that is coming from you. Let's talk about mortgage insurance for a minute. So I alluded to this earlier. On a USDA loan, the upfront mortgage insurance premium is called a guarantee fee. And on USDA, this is 1% of the loan amount. So if you borrow $200,000, the guarantee fee is $2,000. But it's really nice because you can finance this fee into the new loan. So in that example, borrow $202,000. The annual fee is 0.35%. So what we do is we take 0.35 times the loan amount divided by 12 months, and that's your monthly amount. So 0.35 times your loan amount divided by 12 months. Now, I, as your lender, will calculate that for you. I don't expect you to memorize that. There's not a test at the end of this or anything like that. And for sure, post your questions below if you have questions on that. So the next concept I want to talk about on qualifying is GUS. This is USDA's automated underwriting system, government underwriting system. So this is a system that we as lenders have to run every single borrower file through to see if you're approved. So it's based on the inputs of your income, your assets, your credit report, all these things, and GUS tells us whether you're approved. Now, GUS requires a 620 minimum credit score. So that's the minimum on a USDA loan. As your score gets lower and closer to 620, especially if it's below 640, it becomes more and more difficult to get a GUS approval. So then we run into what's called a manual underwrite. So if we don't get a GUS approval, you have to meet other requirements. So a couple of these requirements are 680 minimum credit score instead of 620. Also, the new USDA housing payment has to be lower than your current housing payment in order to qualify for this. There's a few other requirements, but those are two of the key ones that I wanted to mention. And you have to meet all of these requirements, not just one of them. So this is really important. And generally speaking, for GUS, they're looking for a 32% front end ratio. So what that means, what we mean by ratio, that's debt to income ratio. And the front end ratio, that is just the housing payment, including taxes, insurance, and HOA if you have one, divided by your gross income. So your total housing payment, including HOA, divided by your gross income. That's your front debt to income ratio, front end debt to income ratio. And that can't exceed 32%. And on the back end, which is all your debts combined, divided by your gross monthly income. So they add in car payment, they add in student loans. That can't exceed 44%. And sometimes on GUS, we can get an approval above those numbers. Extremely rare. I haven't seen it before. On a manual underwrite or this, without the GUS approval, you cannot exceed those numbers. Those are hard line numbers. Next is property requirements. This is really a really important thing to talk about. So, like I was saying, USDA is for single family housing in rural areas. So you can't buy a multi-unit property. It has to be in a rural area. But this doesn't mean some remote backwoods area. A lot of small towns also qualify. Towns that have 5,000 people, 7,000 people, suburbs that are further out from metro areas like Denver, for example. And I'm going to show you the USDA map. So USDA has a map feature where you can search a particular address or a particular area, and you can see if it's a USDA eligible area. So I'm going to show you that in just a minute here. USDA is primary residence only, so you can't buy an investment property or a second home through USDA. There's no acreage maximum. There's a little bit of a caveat to that, though. You can't, the value of the land can't be too high of a percentage compared to the house. So you can't buy a 80,000 acre ranch that has a house on it that's worth 500,000 and the ranch is worth 50 million, something like that. So within reason, no acreage maximum. But there's technically no maximum according to the guidelines. And then the last thing I want to talk about is manufactured homes. So manufactured homes are a little different with USDA. You can only buy a brand new manufactured home that's been completed within the past 12 months and that has never been occupied. So you can't buy an existing manufactured home that's a resale home. And this comes up a lot in rural areas. So it's a really important one that I wanted to mention. The other thing on manufactured homes is that they have to at least be a double wide manufactured home, no single wides, and they have to be on a permanent foundation. So in other words, they have to be affixed to the land, and you have to be purchasing the land along with the home. Very important distinction. So here's an example of the property eligibility map. This is just north of Denver. So if you're familiar with Denver, you'll recognize a few of these names. Firestone, Frederick, Dacono. Over here is Boulder, Niwot. Here's the south part of Longmont. So you can see there's large areas that are USDA eligible. So the shaded areas are not USDA eligible, but the unshaded areas are eligible. So in other words, all those developments up in Dacono, Frederick, and Firestone, you can qualify for a USDA loan. So this is really a really important thing to know, is to not just assume if you're in a metro area that you can't qualify. Now, as you get closer to Denver, the entire map is not eligible, but on the outskirts, definitely USDA is a possibility. So it's something to look at, and I can help you to look at areas to see if it's an area that could qualify for USDA. So in summary, you cannot get a USDA loan if these things are true. So the first thing is if you have tighter debt ratios, debt to income ratios. So if you're if the housing payments close to that 32%, or especially if it's over compared to your gross income, or if your total debts is close to the 44% or over it, then you almost certainly can't qualify. If you're in a restricted area or certain geographies, so like if you're not within an area on that map that qualifies for a USDA loan, it's an automatic decline. If your income exceeds the set limits for household income, remember it's household. Everyone in the household that's working has to be taken into consideration on that. If you own any other real estate, so you can't own other properties when you buy a USDA loan. If you're considering a property with 2 to 4 units, not super common in rural areas, sometimes in small towns though, you cannot use a USDA loan. So you can't buy a duplex or a fourplex or something like that. Or if you're relying on a non-occupying cosigner. So everyone on the USDA loan has to be living in the property. So very important to keep in mind. Now there are programs if you need a non-occupying cosigner that we can talk about, but USDA is not one of them. Let's talk about refinancing for a minute. So on a refinance, you cannot pull cash out of your property on a USDA loan. So a cash out refinance is where you borrow more than your existing loan balance and you get money in your pocket, whether it's to pay off debts or do home improvements, or two common reasons. Can't do a cash out on a USDA loan. You can refinance into another loan though at any time. However, if you're just doing a straight what's called a rate and term refinance to lower your USDA payment, USDA has an awesome program called a streamline refinance program where they have much less requirements, less strict requirements. The process is fast and easy, and the cost is low. So let's talk about the success rate of getting a USDA loan and getting your offer accepted with the seller. The first thing is really how the seller perceives it. So appraisals, they can be a little bit more strict on a USDA loan. So the standards of the property can be more strict. Generally, USDA loans, they're looking for health and safety related issues. So sellers can be concerned about this. So one way that I help mitigate this as your lender is I'm going to call the listing agent, the real estate agent that has the house listed for sale, when your agent puts in the offer, to help not only strengthen your pre-approval and your offer and talk to them about how strong you are as a buyer, but also to get their questions answered, to address their concerns about a USDA loan so that they can then relay that to the seller and help the seller feel more comfortable with the USDA loan. Another seller perception is that USDA loans are slow. This is because sometimes buyers go USDA direct, which, as we talked about, USDA can be really slow in the process. They can lack communication, and there's kind of a bad word out there about USDA loans amongst real estate agents especially, but some sellers have heard of it and have heard bad things. They've heard that USDA loans can be slow and difficult. But if going through a lender like me, like a broker that does these loans on the guaranteed side, it can be just as fast and just as easy as any other loan types. This is another thing that we'll talk to the real estate agent about. And the last thing is sellers just aren't familiar with it. A lot of sellers don't know what USDA is, and they're scared to accept an offer for a program they're not familiar with. So this is why it's really important to get pre-approved with a lender that knows what they're doing on USDA loans. That's where I come in. I have a no obligation consultation that I'll do for you, no cost to that. There's also no cost to get pre-approved. So thank you so much for watching this video about USDA home loans. Again, just reach out if you have any questions, and have a great day.